You've probably seen those bright flash videos on YouTube promising to turn pocket change into a fortune. You will say something like, invest $250 a month at roughly 10.5% returns, and after 35 years you will end up with about 1.9 million. The stock market, for example, the S&P 500, has historically averaged about 10 to 11% a year. But here is the catch. These videos skip some important details. For example, there are always fees. Even a low-cost index fund might charge just around 0.5% per year. Sounds tiny, right? But over decades it will affect your returns. In practice, that 10.5% assumption might slide down to 10.4% or less, meaning noticeably less money in your pocket at the end. Another big factor is inflation. It's a very important factor, by the way, and basically about 30% of that 10.5 return just keeps up with rising prices. So in real terms, your spending power might only grow around 7 to 8%. Put simply, that fancy 1.9 million in 35 years might only have the buying power of about $400,000 today. And don't forget taxes. Whenever you get dividends or sell investments for a profit, the government takes a cut. Those taxes mean less money back in your account to compound. After paying all those taxes, that 1.9 million number shrinks even more. Honestly, you might end up with only a few $100,000 that you can actually spend. And of course, there are market crashes. The stock market never goes up in a straight line. Wild dips happen. Remember 2008 and 2000? The S&P took years to recover. If you panic sell during the crash, you'll lock in big losses instead of riding it out. This isn't to say investing is hopeless. Just be smart about it. One simple tip is to gradually increase your monthly contribution as time goes on. Even small raises, just enough to cover inflation or a bit extra with each raise, can really boost your balance thanks to compounding. Also, if you can, use tax-advantaged accounts like retirement plans, keeping more of your money invested instead of handing it over to taxes. Upfront means more compounding working for you. Diversify your portfolio. Seriously, don't put all money in one place. Add some bonds, real estate or international stocks along with your regular stock picks. For example, I'm adding in my portfolio SVRD ETF, is developed world ETF. This might mean growing a bit slower in good years, but it really works like a protection in bad years. Also, check out dividends. Companies that pay steady dividends give you cash even when stock price drops. Reinvest those dividends, and over time they start earning returns too. Buy on the dips if you can. Many times you have great chance to pick up stocks at lower prices. Those cheaper buys often pay off big when the market recovers. And above all, be patient. I mean, compound interest works over years, not weeks. Stick to your long-term plan, and 20 to 30 years of steady investing will likely pay off much more than chasing every hot tip. So yeah, the stock market can grow your savings, but it's not a magic ticket to instant wealth. Instead of chasing crazy returns, focus on what you can control. How much you save, investing regularly, and keeping calm during market swings. Successful investing is usually slow and steady, not a flashy get-rich-quick scheme Stick to your long-term plan, and over decades, your money will likely grow way more than if you chase the latest hype. If you found this helpful, please give it a like, share and subscribe for more videos.